So private capital is more than, institutional capital is more than sniffing around, and I will tell you it's changing very, very fast.
Right, when I hear that from our guys all the time, and I know that's, again, I think it just comes from what we've been talking about, just the insanely strong fundamentals that retail has, and then also just some, a little bit of fear about some of the other property types as well, which, there's a little bit of, people are a little unnerved about where some of those are going, and so I think that the retail finally is the safe choice in a lot of cases.
Certainly the grocery anchored part of it is the safe choice, but I think we've seen it's changing really fast right now, Brandon. So we tied up 2 assets that we're going to close the acquisition of. We tied it up in the first quarter. We're about to close one this week, one next week. In both instances, it's a new institutional investor to us.
Wow.
In one instance, that institutional investor has not made an investment in a retail real estate asset in 2 decades. So that is truly coming on. That's not coming off the sidelines. That's coming from way left field. And we have just raised capital for a 3rd transaction, which will close in early July. And again, institutional client, 5th fund, have done 0 retail in the last 3 funds. Wow. So all of that, I think, starts with the fundamentals, and we've talked about the fundamental story, you and I, before.
Yeah.
The fundamental story has not only been real, it has legs, it has depth, high construction costs, low rents, mean there's a lot of runway in existing retail on the fundamental story. That is going to continue. Rent is going to continue to grow at a much higher pace year over year.
That I agree with. Yeah.
And I think we have a fair amount of runway here, right? I mean, if you're sitting there with boxes in the low teens in a power center, replacement rent to build a new center across the street, if there's land, is $30 plus. That's a lot of runway. Those institutional capital sources are all coming in from a little bit different angle, but I think each of those angles is important to talk about. One is coming from the fundamentals are really good. There are very few other places we can deploy capital safely. We're going to go. In every instance, whether we've done a deal with them or we're talking about doing a deal with them, they are all going, I am not going it alone. I have to do this with best-in-class operator. So that has been a huge boon for us and other people like us. Right. And there are other groups like us who are also, simultaneously, feeling around for where that institutional capital is. For groups that have historically been closed-end funds, they are really shut out of the office space now. And even multifamily, I think, is very, very difficult given the fact that you can't attain positive leverage, right? They're working in a negative leverage environment. And that is totally a big part of the story for these other 2 groups who also haven't done a lot of retail, none really for one of them in a very long time, but they need to do it now because otherwise they're not going to be able to deploy their capital.
Right.
And again, the commonality is that if we're going to do this, we have to do this with a best-in-class operator. Best-in-class operator should have skin in the game, which we always do. And we need to have an appropriate promote structure to be able to make sure that we have an opportunity to get rewarded for adding value, and the institutional capital is prepared to do that.
Yeah, I think it's interesting that you just mentioned about how there's a little bit of urgency to get into it, and what I think is interesting about that is I was just talking earlier about how retail is kind of funny because you can't just decide to build retail anywhere, and we've already had several years, a decade of no new retail construction, and so unlike the other you just mentioned multifamily, multifamily is still getting built in a lot of places, not as high as it was, but there's also like the build to rent, the single family houses that's going.
That has been eating capital. Yeah.
Right. So when you think about on the retail side, you kind of do want to get in that first wave because nobody's really building great new assets, at least not at a high level as some of the other property types are going.
No, and I think the very limited amount of new retail development you're going to see is going to be heavily driven by the retailers. I think the smart, clever retailers, particularly the ones we do business with, are saying, if I really want to grow, it has to be with a store. It's not going to be with e-commerce. It has to be with a store. That's where customer acquisition cost is the lowest, most efficient. That store is also going to provide all sorts of benefits to the last mile of the distribution of the online omni-channel experience. And then, but we're seeing groups like Target, Walmart, they're bringing back their development groups, and they're saying, look, it doesn't make any sense for us to rent. Right? Developers' cost of capital is higher than ours. Dick's is also all in for new store development, and they understand, House of Sport is a killer. It's an incredible concept. It's generating tremendous traffic, but it is not cheap to build.
No.
And Dick's is, putting their money where their mouth is, because they believe that is the game changer for their brand. And they want to get going. But again, their cost of capital is lower than most developers right now. The disruption in the capital markets is the only thing that is holding the sector back from being even more popular in the broader multi-strat investment community. The only gate that's there right now for institutional capital is, in many instances, the deal people that we are working with are going, I got to do a lot of work with my investment committee, because they have spent a decade or 2 decades saying, don't bring any retail in here, don't bring any retail in here, don't bring any retail in here. And now the people with boots on the ground know that they have to do retail, and that is a good risk-adjusted return right now for those institutions, but they have to get through re-educating their investment committees, and we've seen that has been a process, and I give kudos to the 3 new partners that we have signed up in their willingness to do the work they needed to do internally to carry the message, and it's been very constructive.
I still hear that from time to time. In my world, there was a few months ago, I was talking to an overseas group, and it's interesting how getting this information out, like, it's still a surprise to some people. Like, when I started talking about the strength of retail fundamentals, they were just floored. We heard a completely different story, and it's like, no, we're at all-time low availability rate. There's continued demand. A lot of the struggling properties, the right thing is happening, where they're getting reimagined or redeveloped into something different, and really, it's something you really need to be looking into, because all is good right now, and it's on a very strong momentum.
I think it's important to touch on the fundamentals for a minute, and we're seeing this, which is legacy assets that we've owned for quite some time, 97% leased, 98% leased, and we continue to have inbound from national tenants who are like, we need to be in these markets now, and it's wild, but we're leasing some space that we haven't leased in a very long time. So the deals come through for approval, and wow, that's a big spend on 5,000 feet or 7,000 feet. Well, it's someone moving out of a mall. By the way, this space has been vacant for a long time, and it's only got a very small number of square linear feet of frontage, but this national tenant, to get out of the mall, is willing to take it, but the spend is a little bigger. The returns on that incremental capital that's going in are very, very good. So that's the good news. And again, I think that in many markets, we are seeing a significant sector rotation now out of those B and C malls. A lot of people who hung in and stayed in those malls when there was 1 anchor dark. If you get to 2 and 3 anchors dark, it's really time to find another home. And in that particular instance, some of these apparel tenants are coming out of the mall, and now they're sandwiched between a Walmart Supercenter on one side and a lineup of TJ Dick's, Home Goods on the other side. There's more sales and more traffic in the open air center than there is in the mall.
Yeah.
We have some situations now where some of our 25, 30,000 square foot off-price apparel players are doing as much volume as the department store in the mall is.
I'm sure that's true.
It's wild.
Yeah, you had mentioned something earlier. There's also this shift between, one thing that I think about in regard to the mall store versus, and I like malls, and the best malls have never been better, but and the best ones think about themselves as a destination. But when you think about tapping into e-commerce, the open air strip is actually much more suited for that, easy come, easy go, easy pickup. And when you think about, you had mentioned earlier about the value of the store in promoting sales. We put out a report on street retail recently, and in 2019, e-commerce was a little over half of where retailers were building their sales was through e-commerce. Now it's completely reversed. I think e-commerce store sales accounted for 78% of the growth for retailers, and I think it was in 2022, and it was just 22% was e-commerce. And so we had that big boom, but now it's back to the basics, and you need to have a hot store, and that needs to be the ambassador of your brand, and e-commerce is a tool that you use to get there.
Right. It's increasingly, how do I drive traffic to the store with my online presence, as opposed to avoid the store with my online presence. And I think, look, we're going to see a pretty big shakeout here in digitally native brands. I don't think there's any question. A lot of them are out there looking for capital. A lot of them have not gotten to profitability. I think we're going to see some consolidation there. I don't think there's any question about it. It's a necessity. Look, there's creative destruction in retail. There always has been, and there's no reason that that's not going to occur with the online digitally native brands the same way that it occurs with some of the traditional store brands that lose their relevancy, lose their freshness, stop innovating. I do think that open air has this undeniable advantage around helping fulfill that the mall store just can't. It's not anybody's fault. You've got to park in the deck. You've got to get the toddler out of the car seat. You've got to put the stroller together. You've got to go find an elevator because the stroller doesn't go on the escalator. Now I got to find the store, and you get to the store, and lo and behold, the stock room for the store is not attached to the store, but it's somewhere else. And the better the mall, the more separated those are.
Yeah.
But I do think, and I had breakfast this morning with a friend of mine who has acquired several what I would consider to be still relevant, better B+ malls. And quite candidly, the sales performance they're seeing was really staggering. And the best malls are doing more sales than ever. They may not be doing as much traffic though, right? Because they've replaced Hallmark with LVMH. Yeah. The sales per square foot have gone way up, but the foot traffic hasn't changed, or perhaps it's even fallen a little bit, right? You don't have to sell a lot of handbags or a lot of iPhones to move the needle on the per square foot basis that way. But I agree with you. The top malls still definitely relevant.
Yeah, and I think it's interesting to hear. I live in Miami, obviously, and just all the development that's gone up around Aventura, because everybody wants to be there, and now even Bell Harbor, they're exploring perhaps putting in like a mixed-use component to that mall, and now there's talk about potentially building up the area around the design district. And again, it's just interesting to see how retail places are re-becoming the center of this, and there's just so much interest in them now, and it's about these places that can place make themselves, like malls. They serve a completely different purpose than the open air center, and both can exist in the same world, and it's okay.
For sure. Although I think Miami, from a luxury perspective, is one of the most complicated markets on earth.
Yeah.
I mean, it's like Hong Kong complicated, but it's dynamic for sure.
Yeah.
And look, right now, we've never been in a position in our particular business, which is all about value, as you know, where our retailers are really blessed to have tremendous merchants at the helm of these companies. And that's making a big difference. You look at the caliber of the leadership team at places like Walmart, Target, TJ, Ross, Burlington. It's really, it's helpful to our business. And I think sometimes in the real estate game, we lose sight of how important it still is. Even in value, the role of the merchant is still incredibly primary. And we're very fortunate right now. You look at what sales growth has been at many of the off-price players and how they have kept themselves fresh, accessed goods. I've been very impressed. And it's great to partner with them because they're driving traffic.
Yeah. Awesome.
Great to have you, my friend.
Yeah, absolutely. Great conversation.